certificates of deposit, it works like a normal bank deposit, and you agree upon a time with the bank, and at the end of that time, you get paid the interest for the amount of money that you gave them. Commercial paper is used by large, well-known companies, and instead of going to borrow money, they issue their own debt notes, and they're issued with a 1 to 2 month maturity, which makes it very low risk because it's easy to track the performance of the company in that amount of time. And then bankers' acceptances is an order to a bank by a bank's customer to pay a sum of money on a future date. Once approved, they can be traded on the market, and whoever owns the acceptance at the end of the maturity gets paid by the bank. Euro dollars, it works exactly like a time deposit, except it's in a foreign bank, so it's free from Federal Reserve regulation. And then repos and reverses, they're usually short-term loans backed by the government. They're traded overnight, so basically a dealer sells government securities to an investor with an agreement to buy back the next day at a higher price. And then finally, federal funds. This is only available for banks because the banks are required to have a minimum balance in reserve with the Fed. Banks with excess reserve lend to banks below the minimum. These loans are done overnight and are arranged at a rate of interest called the federal funds rate. So money market securities are not free of risk. Even though they're very low risk, they're still not exempt. So for example, like this one, the figure shows that bank CDs have consistently paid a premium over T-bills. So this premium increases with economic crises. You can see that the percentage points increase at every single financial crisis we've had. And then the capital market is the other subsector. The capital market is long-term, liquid, and low risk.
So Treasury notes have maturities from 2 to 10 years. Treasury bonds have maturity more than 10 years, and the only difference between the two is actually the maturity length. And then the interest on both of them is paid semi-annually. And TIPS is just like an acronym for Treasury Inflation Protected Security, and those are Fannie Mae and Freddie Mac, and both of those are used. Fannie Mae and Freddie Mac are to provide liquidity and stability and affordability in the mortgage market. And then municipal bonds are municipal bonds are debt obligations issued by states, cities, counties, and other government entities, which are they're used basically to like build our schools, our highways, and our sewers. Everyone needs it. And then the income from the bond is not tax exempt, unfortunately. And then this is just a graph. Look at it. So taxable municipal bonds are typically used to fund projects that don't directly benefit the general public, while tax exempts are for public projects. Corporate bonds are debt obligations. Corporate bonds are debt obligations issued by a corporation to fund capital improvements, expansion, debt refinancing, and acquisitions. Calpol bonds, Calpol redeeming the bond at some point before the bond reaches its maturity date. Convertible bond is when you could actually take the bond and buy stock with it. Mortgage-backed securities are similar to bonds that is made up of a bundle of home loans bought directly from the banks that issue them. conforming loans meet the funding criteria for Freddie Mae and Fannie Mac, and then private label loans are actually loans that don't meet the criteria for Freddie Mae and Fannie Mac, and those are similar to like subprime mortgage loans, which kind of messed us up in 2008.
Alright, so we have equity, and that's what in the asset classes. We have fixed income, equity, derivatives, and then from equity we have preferred stock, common stock, and ADRs. Common stock, we have ownership, we have residual claim, which means shareholders have a right to profit from the company. Limited liability, which we're limited to the fixed sum we agree to. And then preferred stock, we have perpetuity, which is there's no fixed maturity date on the bond. We have fixed dividends, which means there's a guaranteed dividend paid out each year. So say a company is bought by a famous singer and he runs it into the dirt, you're still going to get paid a dividend throughout the year. You have priority over common stock because preferred stock is better. And we have tax treatment. There's no tax, it is treated as taxable income. So basically the ADRs and American Depository Receipts basically are certificates traded in the United States that represent ownership and shares of a foreign company. Okay, so dividend yield, it's the yearly dividends and divided by a purchase price. We have capital gains, which if share prices increase, then you're able to profit from those sales. And then we have our price to earnings ratio, which is price per share divided by earnings per share. We have our Dow Jones Industrial Average, which includes 30 large blue chip corporations. They've been computed since 1896 and are price weighted index. We have our S&P 500, which is a broad-based index of 500 firms, and it is a market value weighted index. Investors can base their portfolios on an index. You can buy an index mutual fund, which is where you can match and track the financial market index by a money amount, and then there's ETF, which is buy exchange traded funds, and the difference between the two is exchange traded funds you have to buy the whole share, while with index mutual funds you can buy a specific dollar amount. Other indices we have US Index, we have the New York Stock Exchange Composite, we have NASDAQ, and we have Wilshire 5000, and then foreign index we have Nikkei, which is from Japan, FTSE, which is from UK, also pronounced FTSE, DAX from Germany, Hang Seng from Hong Kong, and TSX from Canada. In our derivatives, we have asset classes, we have fixed income, equity, and then we have derivatives, which have two components. There's options and futures. A derivative is a security that gets its value from the value of another asset, such as commodity prices, bonds, stock prices, or market index values. A call option, you have a right to buy underlying asset at the strike price, and you can have the value of calls decrease at strike price as it increases. Another word for strike price is an exercise price. With the put option, we have the right to sell underlying assets at the strike price, and value of puts increase with strike price. Both calls and puts increase with time until expiration. Futures contracts. Futures contracts are an agreement made today regarding delivery of an asset, a specific delivery or maturity date for an agreed future price. You can have two positions in this. You can have the long position, which is where you take delivery at the maturity date, or there's a short position where you make the delivery at the maturity date. The comparison between options and future contracts: an option, you have the right but not the obligation to buy or sell, while with futures contracts you are obliged to make or take the delivery upon the agreement. An option is exercised only when it is profitable, while a futures contract, whether long or short position, you must buy or sell at the futures price. Options must be purchased, and the premium is the price of the option itself. With futures contracts, you are entered into without a cost until that maturity date. And that's it.
Thank you guys for listening. Appreciate it.
Shot this out and give it a shot.
Wow.
We're gonna break 5 bars. Got it. Thank
I'm sorry, I'm Steve.
How you doing?